Hey everybody, John Pace with the Pace of Richmond. Hope everyone is enjoying this beautiful day in early March. We just got back from our annual convention with Keller Williams Realty a little over 2 weeks ago, and we had some really good information I wanted to share with you. And one of the benefits of being with the largest real estate company in the world, which is responsible for one of six sales in all of US, is that they have a ton of slides and a ton of great data, and I thought you might get some value out of this. So I hope you don't mind. I'm going to share with you about 6 or 7 slides. Shouldn't take too long, but if you are impatient like me, go ahead and put me on 1.5 or 2 times speed. And when you get to the slide you like, go ahead and slow down and listen at that point. So I hope this is interesting to you. And so the first slide is our home sales. Now, the reason I want to show you this is I think you're feeling this in the market right now. The number of home sales that have been going on as far as the past couple of years is around 4.1 million nationally. And the interesting thing is, if you look back to 2008, when that was the lowest number of sales in that time period, we're matching that. And then you got to go all the way back to roughly 95, 96 to see the same low number of sales. Now, you as the homeowner, you're not going to feel this. You will feel this a bit on the buying side because there's not much to choose from out there as far as number of homes for sale. But as the home seller, it's actually a benefit to you at the end of the day. uh, the other thing that's really impacting things is your favorite realtor on the team. Because from the peak of 2021, we're down about 33% number of homes that are available. And then from roughly the peak of the prior period of 2020 or even 2017, we're down about 25%. So the realtors are really feeling it. The appraisers, the lenders, we're all feeling it. Home buyers are feeling it, and sellers are kind of enjoying it. Now, where we go from here, they're projecting a slight increase, about 4.3, due to rates coming down. We'll talk about that here in a minute. My gut says 27 and 28 are probably about the same, somewhere between 4.1, 4.4, or 4.5, somewhere in that range. Not a huge amount of homes available, but I think the interest rates where they currently are as compared to what people got used to 4 or 5 years ago is what's really keeping these numbers constant. Next slide I want to show you is home prices. Now, this slide goes back to 1990, but if you look at if we had it going back to 1970, 1960, you would see the exact same thing where over time, the trend line or the average appreciation of a home over time is about 4%. Some years a little higher, some years a little lower. But once again, over time, you're looking about 4%. Looking on a 10-year window, 4%. And I've had numerous conversations, not recently, but in the past couple of years, where people were waiting for a market to crash like we did in '08. And we are not expecting that for a couple of reasons. Number one, back in '06, '07, when we peaked, we were 21% above the trend line. Last year, 7.5%. And we're expecting this year to come down a little bit, maybe 6% above the trend line. So there's not as much to quote unquote crash from. And so I don't expect that to happen at this point. And the fact that we have really low inventory and stable mortgages out there, like we did not have back in '08 with all the no doc loans and some other things that were a little creative to say the least. We have a stable market, we have a stable inventory, and I don't think that's going to change or create a crash. And there'll be another 1 or 2 slides here I'll show you in a minute that's going to support that as well. If you want to see what that same appreciation looks like on a graph, going back to 1990 as well, the interesting thing is going back 35 years, the only time a home did not appreciate was during the '06 to 2011 timeframe. Otherwise, you might have had a little bit of appreciation in 2023 of just under 1%. And also back in 1990, you had 2.6%. But over time, your home will make money over time. Of course, unfortunately, people got used to the COVID era where things were going up 10%, 12% year over year. We're back down as of last year, 1.7% nationally. We're a little higher here in Richmond. I think we're closer to that 4% number, 6% in some hot areas. But they're expecting for nationally this year about 2% appreciation nationally. I still think Richmond's going to do better than that. And another way to look at the home prices information is going back to 1954. And this is a fun graph. And the reason I like it is you can see the variance in how much appreciation or homes had. And going back to 1954, we've had 4 years since 1954 where we actually went backwards in appreciation and in value. And the first one was 59 for the Eisenhower recession. The second one was the S&L crisis in 91. The third one, obviously, is the Great Recession. And then the fourth one was in May of 23. We went down about 0.5% that year. And I misspoke. We had a longer area being below appreciation during that '08 through 12, 11 timeframe. So it was a couple year run of being below appreciation values, if you will. But otherwise, everything else was just a year, half a year kind of thing. So once again, oh, by the way, and the other thing that's on here is a lot of these things are they're all either bank related or government related, all of them, which is kind of interesting to think about as well. The next slide I want to share with you is inventory. And I'm going to show you after this one a slide of Richmond, which I think is important to see. When you talk about inventory, we talk about a balanced market. We talk about absorption rate. And what I mean by that is a balanced market is somewhere between 5 and 7 months of inventory. Well, John, what does months of inventory mean? That means how many months would it take for every home that is currently on the market as of today to sell if nothing else came on the market? And you can see back in 2021, nationally, we got down to 2.2 months of inventory, which is really, really short. Balanced market, once again, is somewhere between 5 and 7 months. And in 2025, nationally, we're about 4.2 months of inventory. Now, what I want to show you next is Richmond. And this is a really interesting graph, not graph, but thing, but my highlighter wasn't the most accurate. But you'll see for month supply of inventory for all of Richmond as of January, we're at 1.6 months of inventory. For 2025, we average 1.9 months of inventory. And this is really important because when you watch the news, they're going to be talking about places like Phoenix or Austin, which is having a very different market than we are. And some people take that as that's what the nation is doing, and we're not. Richmond on the whole is around 2 months, a little under 2 months of inventory right now, which means that if the house goes on the market, it's going to be gone in a few weeks, if not a few days. And we're still seeing that right now. And I'm not expecting that to change anytime soon. You will see seasonality around this where we get into the spring and that will get lower, and then we get to the summer or winter and it'll go a little higher. But I'm not expecting months of inventory to really change in Richmond. It might go up to 2.5 maybe, which is still very much a seller's market. So for those clients of ours who are buying right now, they're feeling this. In fact, we're starting to get multiple offers back again now that the spring market has begun. We've had one listing that had 8, another one that had 5 offers on it. And so those things are happening again, another seasonal thing that we see, and that's going to carry through probably till mid or the end of May for this spring cycle. The last slide I want to show you is mortgage rates. And mortgage rates are an interesting thing right now because we have very short memories as a nation, being that we got very comfortable and used to seeing 2, 3, or 4% rates during the COVID timeframe, which was obviously very not normal for what we have. If you go back 30 years to 1990, the average interest rate is 6%. And what do you know? Today, the rate is just about 6%. I think this morning I woke up, it was 6 1/8. And a couple of days ago, it was 5 7/8. So we're sitting right around that 6% mark. But if you go back to 1972, when I was 2 years old, so we're going back 53 years, the average rate over that time is 7.72%. Once again, we're about 6%. So we're about 1.75 points below the 53-year average, which is really good. So while, yes, we do miss the crazy low rates we had, they were fun while they were here. They're not healthy for the economy. They're not healthy for the housing market. They don't belong here. And the rate we have is a solid one. So, but the reason we also have low inventory is because people don't want to sell their house that has a 2, 3, or 4% rate and go buy a 6% rate house unless they really have to. And most of the homes that we're seeing selling right now are for lifestyle changes, meaning they got married, they had a baby, they got divorced, um, empty nesters, growing family, whatever it might be, or relocation for a job. Life happens and they have to make a change, and that's what's really fueling the 4.1 million homes. And the difference between that and the 5.5 million or 6 million homes is the people that want to move but don't want to lose their rate. So anyhow, hope this has been informative to you. If you have any questions on it, reach out to me or your favorite realtor on the team. Happy to go in depth more on this. I hope you guys have a great spring. It's a beautiful day out today, and we're here for you if any questions you might have about the market. Thanks.